So today we're going to talk about rental properties. If you're looking to invest in real estate and have some cash flow and build some wealth over time, buying rental properties might be a good option. What are some of the things that we have to look for? So we're going to talk about that. We're going to talk about what to look for in a rental property, including the area, the condition of the property, the money aspect, and operating a rental property after you purchase. So let's dive in. When you're considering what area you're going to buy in, there's a few different things you're going to want to think about. You're going to want to look at the demographics of the area. Who lives there? What kind of tenant is going to rent this place? What kind of job do they have? What's the median income? What is the vacancy rate? Because each of these things are going to differ from community to community and definitely from city to city. So, if you go somewhere like, National City or San Ysidro, that's going to be a different demographic and a different type of tenant than it would in a place like, La Jolla or Del Mar, right? So in each of these different areas, we want to understand, who our prototypical tenant is, what their income is, what the local economy is like, what the economy is like specific to the type of tenants that are going to be renting this unit. And that'll give us a good idea of, what we can expect when we dive in. Another thing that you want to consider from area to area is how quickly do rents appreciate? How quickly do the property values appreciate? Are there any new jobs, coming in? Because there might be an area that has been underperforming right now, but then, the minute Amazon or Google moves their campus into that area, it can completely change the demographics. So when you're looking at area, you want to look at economics, you want to look at demographics, you want to look at any, future development or other things that might impact the property itself, rents in the area, or the tenant's ability to pay the rent. So those are a few things to think about when it comes to area. Now you're zoned in on an area that you're comfortable with. The vacancy rates, what kind of rent you can command, the price points there, you can afford it. Now the next thing you want to consider is the condition. Now there's two ways to go about this. You can buy something that's turnkey and ready to go, right? So it's something that's already been renovated or in really good shape and the rents are already maximized. In that case, when you're going to pay a higher price for that property, all else equal, for something that's turnkey, ready to go, and already getting maximum rents, you're going to have much less headaches in a property like that. You're going to have less repairs. You're likely to have less vacancy and other issues. Once a property is turnkey, updated, maximized, stabilized, and renting and operated at a high level, you're typically going to pay more for that because you pay more for a property in exchange for less headache, less repair, less risk, less maintenance. Now, on the other side, you might find the same property in the same area for much less, but maybe the rents have been low for a long time, maybe the building's dilapidated. That's not necessarily a bad thing. So some people just want a turnkey operation ready to go. They're willing to pay more, maybe even take a little bit of less returns in exchange for less risk and less hassle. But in another property that's priced lower and maybe in worse condition, for example, if you buy a 4-unit property and all 4 units are dilapidated and all the tenants are paying, well under market rents, what you might do is you might renovate one property and either keep the tenant in there, but you're going to renovate one property and then get that one up to market rents. And then maybe move the tenant out of another one, renovate that one, get it up to market rents. Meanwhile, you're not decimating your income, but you have a plan to slowly and methodically go through, bring the property up to today's conditions, today's standards, and be able to command market rents, which will, at the end of the day, typically allow you to earn a greater return because the rents are going up. Typically, the return on the renovation is substantial. And then you end up with a property that's, you paid less for overall, and you're getting market rents, but the exchange is big risk. There's always risk of construction, there's risk of trying to get tenants out, and then there's also just the risk of vacancies and maybe cost overruns and things like that. So when it comes to the condition of the property, there's really a bunch of different ways to skin that cat. Some people like the turnkey, ready to go, set it and forget it, low hassle. It might be cost a little more money, you might get a little bit less returns, but it's ready to go and you don't have to deal with the hassle. Other people want the sweat equity, the elbow grease, and the potential returns that you get for dealing with the hassle and the headache and the risk of renovating a potential rental unit. So if you're investing in rental property, then it's probably because of money. You're probably not doing it for altruistic reasons. You're probably not doing it for vanity reasons. You're doing it because the numbers make sense, right? Money in, money out. But when it comes to the money, there's a bunch of different metrics you can use, different ways to look at the returns. There's cash flow. That is how much cash is in my pocket net after I pay expenses every single month. There is cash on cash returns, meaning it costs me X amount of dollars in cash to buy the property and maybe to renovate. I'm out of pocket X amount of dollars, and the amount of money I'm making net in my pocket based on that cash. Like, now, most people want something that cash flows, and you also have to consider the appreciation. So when we're talking about the different areas, right? We have analyzed properties in different metro areas. So we're here in San Diego, and if you look at San Diego, there's such a high demand here, and people who are willing to pay such high prices for properties. It's really hard to find really high cash flow producing properties right out of the gate. And the reason is because there's so much demand here that appreciation is a big part of the equation too. I remember at one point with a client, we were comparing, an investment property, an industrial building that they had here in San Diego, and they were considering cashing it out because it wasn't cash flowing that much. They were getting ready to retire. They wanted more cash in every month, and they were considering selling that building and buying, a multi-unit, I think it was a 20 or 25 unit apartment building in Tucson, Arizona. Now, the Tucson place brought in way more cash flow every single month. It was something like the industrial building here, because of the way the financing was structured, was bringing in something like $2,500 a month net, where if they moved the money over to Tucson, it was going to bring them like $8,000 a month. So you would think, all else equal, Tucson's bringing me $8,000, San Diego's bringing me $2,500. That's an easy decision, right? Well, not necessarily, because if you look at the rate of appreciation for these two types of investments in these two areas, if you took San Diego's average appreciation plus the cash flow, and you took Tucson's average appreciation plus the cash flow, at the end of I forget what we analyzed, a 5 or 7 or 10 year period, at the end of the period, you actually end up getting more investment returns in San Diego, even though you're cash flowing less per month because of the appreciation. So when you're looking at the money factor, yes, there's cash flow, and I think that's what a lot of people think when they think about rental properties, money in every month, but there's also the appreciation of the property. And again, going back to our conversation about area, this is a similar thing as well, where in different areas, cash flow and appreciation, might vary wildly in any given community and definitely in any given metro area. So you want to make sure that, your overall rate of return is something that gets considered. And at the end of the day, if Tucson's overall rate of return is, say 10%, with cash flow and appreciation and tax, tax benefits and all those things, and you look at San Diego and it's 12%, looking at those, you'd say, oh, San Diego is the better investment if San Diego is returning 12% overall and Tucson is returning 10% overall over a period of time. But your needs matter as well. So these people were in their retirement years, they were in their 70s. For them, they wanted the cash because they wanted to enjoy their retirement. So for them, watching a building appreciate over the next 10 or 15 years, frankly, they weren't sure if they were going to be around for another 10 or 15, 20 years to really enjoy the fruits of the appreciation. So they might have, they didn't, but I would have understood if they went to Tucson, bought the apartment building, and pulled in more money on a month-to-month cash flow basis to go have fun in retirement. And so even though you're leaving a little bit more on the table overall, your needs matter as well. So if you need the cash flow, you might leave a little return, a little appreciation return on the table to go get the cash flow if there's something in your life that creates a need. Also with the money aspect is the financing, right? So there's a bunch of different ways to skin this cat. I have VA buyers who can buy up to a 4-unit building with zero money down and live in one of the units and collect rent from all the others. People with an FHA loan, you can put 3.5% down on a 4-unit building, live in one, collect rent from the 3 others, and basically have no payment or maybe even cash flow yourself. So these are some options as well, where maybe it's not gigantic cash on cash returns. House hacking is what they call it, right? Where you live in one of the units in a multi-unit building and the rent from the other units covers your payment. So that's another way that you are now invested in real estate. And as rents increase, that could end up turning into a cash flow positive situation over a long period of time. So all of that to say is there's a million different ways you can skin the cat with regards to financing, right? You can put 0% down, 3% down, 10% down, 20% down, live in it, don't live in it. It doesn't really matter. The point is we want to make sure that we are structuring the financing in such a way that helps you meet your personal goals. Again, for some people that's going to be cash flow. For some people it's going to be appreciation. For some people it's just going to be house hacking, right? Like just getting my payment down, my responsibility, my payment as low as possible. And so make sure that you get with your real estate professional, your lender. If you're in San Diego, give us a call and we can walk you through the different options that you have when you're thinking about buying a rental property, and we can make sure that whatever financing you choose and whatever metric you are after with regards to returns, that we can put something together that works best for you.